Hi, guys. How are you this morning? I hope you guys are all doing well. Thanks for joining us at our regular webinar with GDAR. We are doing these a couple of times every week, and we know that you're going to find them informative. So let's get started. And then I'm just going to keep my eye on things because as people join, we're going to admit them. So today's topic is downsizing in the time of COVID. And I was just going to give a quick update on what's happening with mortgage rates, and should be interesting. So I've got about maybe 20 to 30 minutes. And I'm going to kind of try to keep an eye on things because some of you may have comments, or I'm going to admit people as they come in. So what's going on these days? So just a little bit about, for those of you who don't know who the Mortgage Center is and are joining us today, we are a franchise. And there are 100 independently owned franchises across Canada. We are recognized in the top 1%, which is amazing. Just to kind of give you an idea of how many agents there are 1,400 agents across Canada. So that's a pretty awesome recognition. And I think now, especially with the way things are, you want to make sure that you're working with somebody who knows what they're doing. And we've been in business for 20 years. I think I've personally done 10,000 mortgages. So when you refer your clients to us, they're not going to get someone like a junior person like you often get at a bank. They're actually going to work with somebody who knows what they're doing. And we love working with realtors. So we've, over the last few years, we've contributed to GDAR, and we continue to support you guys because we love working with you. So a little bit about what we'll cover today. And I mean, many of you are also designated like senior specialists. And I'm just going to quickly go over the financial reality of most people who are over the age of 55. We're also going to talk a little bit about some of the best uses for a reverse mortgage from a realtor's perspective, because I want to make sure that whenever we do these webinars that it's a value to you. And then what's happening with mortgage rates. I'm going to switch gears a little bit and talk to you about our recommendations on fixed or variable rate mortgages. So here we go. So what's the financial reality of people who are 55 years or more? And I mean, some of you may find yourself in that category. Really, their home is the largest and biggest asset that they have, and it could depreciate in value. You know, as you know, baby boomers and seniors are the fastest growing demographic. They're entering into their retirement years with longer life expectancy than ever. And pensions aren't keeping up with just the cost of living. So this is just the financial reality. And people may find also too with the pandemic that any gains they've made over the last 10 years with their own investment portfolios have completely eroded. So they're going to be looking at how they can use the equity in the home. And I know when I've been talking to our providers who provide the reverse mortgages, and there's a couple out there, really that's going to be now a huge market. And for those realtors who are joining us today, good for you for joining us, because you need to know this stuff. So what is a reverse mortgage and who qualifies? So here's the really neat thing is, because I do get a lot of calls from people who are over the age of 55, a reverse mortgage, the ideal I think the ideal age is somewhere between 68 and 75 years old. So for example, a 75-year-old who owns a house in Guelph could qualify approximately for a reverse mortgage up to 40% of the value of their property, right? So let's just say if their house is worth like $700,000, they could possibly qualify for a reverse mortgage of $280,000, which is good. And I'll talk to you a little bit about how you can use that. I do have seniors talk to me about debt consolidations and possibly using a secured line of credit. And again, we'll get into that. But secured lines of credit require income qualification. So if we're dealing with a senior who's on a reduced income who already has debt some debt, but also maybe their credit history is not where it needs to be for a secured line of credit, a reverse mortgage is a great option. So that is a little bit about who qualifies. Again, there are no credit checks, and you don't have to make regular payments on the reverse mortgage if you don't want to. Like, some people choose to do that, but many don't need regular payments. So again, the ideal age is anyone over the age of 55. However, I just find to really kind of tap into the equity of the house, you're looking at 65 or more. And it really doesn't depend on the size of the home. Again, where the reverse mortgage is, they'll look at postal code areas, the type of home, and the age of the applicant, and then that's how they determine the loan to value. So what really is the best use of a reverse mortgage from a realtor's perspective? I really think it's an opportunity for you now to connect with some of your older clients who've been thinking about selling, and just like reaching out to them, because they may have the opportunity to purchase a property now, especially when the market's a bit soft, and not have the pressure of selling their house. So that's one of the ways that you can use a reverse mortgage. So I said, email clients. I think I've been doing a lot of phone calls. We've been doing a lot of phone calls here with clients and just reaching out to them via telephone. So it's a really great opportunity to talk to people, especially those clients who you've wanted to talk to, who may have told you a few months ago or a year ago, hey, listen, I'm thinking of moving. So one of the ways that you can use a reverse mortgage is for those people who are downsizing. And I've got an example here. Many older clients are looking to downsize so that they can pay off some debt, or also maybe get rid of their existing mortgage. And so I've got an example here for you. So I've got a client, and let's just say they're selling their home for $500,000, okay? And they have about a $200,000, let's just say $150,000 mortgage on the property still, and then maybe another $50,000 of credit card or line of credit debt. So after everything is said and done, they're probably left, just using simple math, for about $300,000. Now, if they're selling for $500,000, let's just say they're selling in Chatham or London, and they're moving to Guelph, $300,000 isn't going to get them very much. So what they can do is, one way to kind of look at this, they can bank $100,000 and still have $200,000 left, and then they can use that $200,000 and possibly buy something for $350,000 or $400,000 using the chip. So it kind of gets them into the market or the location where they want to be. And we've actually, that's a really great option for people who are moving from an area where home prices are a lot less into Guelph or Kitchener or Waterloo, Milton, for example. The other way you can use a reverse mortgage is actually to buy another house. So it doesn't have to be on a primary residence. They don't allow them on rental properties. But let's just say if you've got a client who kind of wanted to contribute towards a family cottage, now would be maybe a great time to contact them. And the reason for that is I think many vacation areas, the home prices are going to soften. So now would be a good time to look at that option. They can depending on how we structure the file, we can do the reverse mortgage on the vacation property if they're going to be the only people that are involved. Or the other thing I was thinking about, you could do chip mortgage or a reverse mortgage on their primary residence. Let's just say access $150,000 in equity, and maybe they come in alongside with their kids who have some money as well, and then they can buy the cottage property together. So that's another opportunity I think you want to look at, especially now considering home values. And then lastly, gifting money to your children. So some of the questions I have, because I think what you'll find is a lot of people's investment portfolios have really depreciated in value. So the money that they may have set aside to gift their kids or grandkids no longer is there, but they still have their own home, which is, again, normally their largest asset. You can do a reverse mortgage to to gift that money for a down payment. And you know as well as I do, there is an advantage to having the 20% down because you don't have to pay the default insurance. So again, if you're working with, you may have clients that you've helped move in the last, that good clients from the past. I know we've been in business for 20 years, so we've got a really great following in the area, reaching out to them and saying, hey, you know what, now might be a really great opportunity for your kids to actually buy a house. I know we've helped several first-time home buyers who have good and confident income stability buy homes, and there's not 20 other people competing against that same home. I do have I wanted to touch on this topic is what's the difference between a reverse mortgage and a secured line of credit? Because I do get that call. So the reverse mortgage, one of the things that's unique about it is it doesn't have a monthly payment. So if you find, and we go through this analysis with our clients, so if you find that you're on a reduced income, want to access the equity in your house, the reverse mortgage would be a better option because, again, reduced income, so credit, and maybe don't have the income to make the payments, the reverse mortgage would be a better option. Secured lines of credit are a great option if you have good income into your retirement or and can afford to make those payments. The interest rates right now are a little bit lower on secured lines of credit, and the costs are about the same. So when you send somebody over to our office or when we talk to them, we certainly go through that analysis. Some of the common questions we get about reverse mortgages, and here's the cool thing is that we are actually, our office is a certified reverse mortgage provider, so we've taken some special training to make sure that we can answer these questions, and I wanted to kind of go through some of the common questions. Will the homeowner own more than the house is worth? And that's never the case. I mean, the last thing that some of these institutions will want is bad publicity. And remember, the loan to value is based on the client's age and the projected longevity. And they've got some really great calculators to show even if the home doesn't appreciate in value, in 99% of the cases, people do have equity left, okay? Will the bank own their home? No, they are actually registered on the title of the property. So the homeowners, they do not have to change title ownership. They are still required to obviously pay the taxes and maintain the property. So the bank won't own their home. What happens if the homeowner has an existing mortgage? So sometimes I may see clients that have maybe a $50,000 mortgage on the property or a current secured line of credit. That reverse mortgage actually becomes the first mortgage on the property. Should a reverse mortgage be used as a last resort? In my opinion, I don't think so. I think if you're kind of in your late 50s, early 60s, and would want to explore the options, a reverse mortgage is always a good thing to look at. And what are the fees? So the fees on a reverse mortgage are typically a lender fee of about $1,800, and then the cost for the appraisal. But the costs can be incorporated into the mortgage, so it's no out-of-pocket cost usually. And what if the homeowner can't afford to make the payments? And this is the main difference between a reverse mortgage and a line of credit. Like if the borrowers cannot make the payment on the line of credit, that's a problem. But with a reverse mortgage, you can choose to make payments, but in most cases, the borrowers do not make the payments on the loan. So next steps on building your pipeline, obviously review your client database. That's something that we're doing at our office. Call or email your clients. I think with this market, you want to give people a call and then put them in touch with us, and we'll make sure we make you guys look good, and we'll do some good follow-up with them. So I wanted just to switch gears a little bit and to discuss mortgage rates. I'm going to It's somebody here. So switching gears right now, where are we here? So I look at mortgage rates. So I wanted just to give you, just as I'm finishing up the presentation today, what's happening with mortgage rates. This is always on everybody's mind. So let's have a look. Mortgage rates. Crazy times. Oh my goodness. So just a refresher on how mortgage rates are set, because we've got two different types of mortgages. We have variable and fixed rate mortgages. So the bond market, it affects, it really has an impact on fixed rate mortgages. And this is the way the consumer looks at it. What we do at our office is we track the government of Canada. We just go to the Bank of Canada, not the government, the Bank of Canada 5-year bond yields. You can just type it in and we look to see what's happening. And I checked them this morning just so I knew what was happening. And so for example, in January, the beginning of January, I'm going to admit some other people here that are joining us late, but we always appreciate people joining us. 5-year bonds at the beginning of January, the yield was at about 1.43%. And so just the relationship between the bond market and the stock market, they kind of work in tandem. So when there's uncertainty, large investors, and these are people and institutions that have trillions of dollars under investment, they move from the stock market into the bond market. And what happens is the bond market, government bonds are obviously a more secure place. So when there's a movement from the stock market into the bond market, it drives the rate of return and the yields down. Okay, and so with sort of at the end of February, the beginning of March, we saw quite a large movement from the stock market to the bond market. So I was kind of tracking where interest rates are going because we do that on a daily basis. It's our job. At the beginning of January, the bond yield was at about 1.4, 1.43. Now we're at 0.43%. So it's gone down quite a bit. So so what we're talking about right now is why, if the bond market and the overnight lending rate has gone down, why have rates gone up? And I'm going to share that with you, but I wanted to give you this background first. And then if we go to fixed rate mortgages, again, this is the way the consumer sees it. The Bank of Canada overnight lending rate. So when you hear the Bank of Canada has changed their rates, they can make 16 rate announcements a year. Right now it's 0.25%. That has an impact on the mortgage prime rate. And then in the different variable rate mortgages. And again, this is the consumer's perception on things. And I also think that a lot of times when I hear the overnight lending rate, you hear the Bank of Canada lowering rates, people think that 5-year fixed rates or fixed rates are coming down too. And sometimes they don't work in tandem. But one of the things that's often overlooked is something called the banker's acceptance note. And I'm going to just touch base on that. So again, why is the bond market and the overnight lending rate going down and mortgage rates are going up? So really, that relationship between what's happening in the market versus how mortgage interest rates have been set that relationship doesn't exist anymore because we're in unprecedented times. So typically, what we do is with 5-year fixed rate mortgages, if, for example, I said the bond yield was at, earlier this year is at 1.4%, typically the premium on that to send a 5-year fixed rate mortgage would be about 1.25 or 1.75. So for example, if in January the bond yield was at 1.4, and again, the typical price difference or premium would be 1.4 plus 1.75, which gives you the 5-year fixed rate mortgage. And I can tell you in January, the 5-year fixed rate mortgage was just over 3%. Now with the bond yield, remember how I said the bond yield is at 0.43. If I just take 0.43 and I add 1.75, which is the typical relationship, I get a 5-year fixed rate mortgage that's supposed to be at 2.2. But what we're actually seeing in the market is that 5-year fixed rate mortgages are somewhere between 2.69 to 2.89%. And why is that? Well, banks are charging about 0.5% risk premium on these mortgages because of all of the extra inherited costs, for example, for deferred mortgage payments and just that credit risk. So that's an interesting perspective for you and just for you to keep in mind. Variable rate mortgages, again, there's the overnight lending rate, which impacts the bank's prime rate, and then that now the prime rate, how variable rate mortgages are priced, are based off of the prime rate. So typically we're seeing like prime plus a certain percentage or prime minus a certain percentage. But there is something called a banker's acceptance note, which impacts this as well. And sometimes they don't move in the same direction. So for example, when the COVID-19 started coming down in the early March, we saw variable rate mortgages go up because remember, banks were charging prime plus a certain percentage, like prime plus 0.5, prime plus, yeah, it was prime, well, prime plus 0.2, prime plus 0.5. Right? And again, the prime rate right now is 2.45. That's eased up a little bit. And right now we're seeing prime to prime minus 0.2. So you're looking at a 5-year variable rate mortgage at 2.45 to 2.25. So the question I always get is, should I choose a fixed or variable rate mortgage? Well, again, if you think about the variable rate mortgages, they're at 2.45, which is the prime rate, to 2.25. And fixed rate mortgages are typically between 2.69 and 2.89. Essentially, what I'm telling people is the cost for security is about 0.5%. So I had a conversation with a first-time home buyer yesterday, and she was saying, like, I'm planning on having a family in the next couple of years. Should I choose a variable or fixed rate mortgage? And I think that would be a good example of someone who's got 10% down, is planning a family, maybe on a reduced income in a couple of years, that they should probably go with a 5-year fixed rate mortgage. So she's decided to pay a little bit extra for that security. Now, if you are in a situation where your debt to income ratio is low and you're a smaller mortgage, and you want to be more aggressive on the principal, a variable rate mortgage would be a good option there. So again, I normally let the clients decide, and I give them good information. So you can always contact us. We are experienced and friendly, and we always follow up in a prompt way. Usually if you send me an email, we get to those quickly. If you don't hear from me in 24 hours, give me a buzz because sometimes we're inundated with emails. You can also check us out at skipthebank.ca. There's a place where you can log in and schedule a 15-minute telephone appointment. And then I also wanted to mention to you, there is a short survey after the webinar is done, and I'd love it to get some feedback from you. So thanks so much for joining us. This webinar will be available to you, and you guys have a great day. Thanks again.